Welcome to ForexTV.com. Today is Wednesday, November 12th. I'm Kathleen Reddington with your New York Forex Market Buzz. The dollar loses to the yen for the third straight day. And now for a look at the latest headlines from the CEP News Desk. U.S. Treasury Secretary Henry Paulson said that purchasing troubled assets, the original intention of the $700 billion bailout package, is not an effective use of the program. The move is a departure from the original plan to unfreeze credit markets through the purchase of troubled assets in September. Instead, Paulson said the money should be used to attract private capital. He also said that the private sector must work in tandem with public assistance. The Treasury Department, the FDIC, and the Fed issued a joint statement. It calls on banks to ensure the creditworthiness of borrowers and to continue raising capital to support the financial system. It also asks financial institutions to work with mortgage borrowers to limit the number of preventable foreclosures, adding that banks should be cautious of organizations that have poorly designed management compensation policies. And according to the Bank of England, inflation in the UK is likely to fall well below the central bank's target rate of 2%, while business surveys and reports point to further contraction in the economy in the fourth quarter of 2008. Industrial production levels in the Eurozone fell 1.6% from August to September, following the previous month's 0.8% rise. Economists had been more pessimistic regarding industrial output levels and had expected a 1.8% fall. Today, we are joined by Rob Booker of Interbank FX. Hi, Rob. How are you today?
I'm good, thanks.
All right, let's start off with the Bank of England. The Bank of England's announcement that UK inflation is likely to fall. Where is this going to put the pound going forward?
Well, it's been under intense pressure already. I mean, the pound, this has been a big subject on my radar screen, is that it seems like the market is just decimating the British pound in anticipation of news like this. I mean, even a year ago or 2 years ago, it seemed like we were waiting for this type of news before we would see the type of declines in a currency pair that we're seeing. Right now, it's as if we're pricing in rate cuts way out into the future on the British pound. I mean, it's fallen, 50 to 60 cents just since last year alone. It's as if the market already is pricing in rate cuts coming down the pike, maybe even 50 or 100 basis points of additional rate cuts. So it makes me wonder if when those rate cuts do eventually materialize, or when this information comes out from the Bank of England about inflation, maybe we've already priced some of this news in before it even comes out.
All right, U.S. Treasury Secretary Paulson made a statement saying that the U.S. economy was more stable, but he wants to also divert money from banks to consumers. After his speech, the yen took off against the dollar. What's in store for the dollar after comments like these?
It seems like we're in an environment where nothing that the Fed can say or any central bank can say is really solving this problem yet. And if anything, we're getting more information on a daily basis and we're understanding that maybe even Hank Paulson, who we pretty much have become the president of the United States, maybe even he doesn't know exactly what to do. They're now no longer wanting to buy troubled assets. They want to spread the bailout package to consumers. They want to readjust mortgages. They want to buy assets of banking companies. Maybe they want to even bail out car companies. I mean, there's just such a diversity of plans that are coming out, and it seems like on a daily basis we're getting information about a new plan. So in the short term, I think that it's volatility both directions. I think that in the short term, we're really looking at a market that doesn't know exactly what it wants to do at all. And it's very unlikely that we're going to get a situation where there's stability or a lot of calm back in the market. It seems like we're headed for another period of volatility.
All right, even after today's hits to the dollar, we saw the IC dollar index go up. Does that change your strategy any, or no?
No, not really. I mean, it's almost like the meta news is more important than the news. It's like the bigger news about the uncertainty in the market, which is unscheduled, right? We get these announcements that are day after day. We get unscheduled announcements about the bailout plan or an unscheduled commentary on inflation rates from a central bank. And those are unscheduled, and it's almost as if the unscheduled economic news is far more influential than some of the reports that we know are coming out. Like the non-farm payroll report came out last week. And as you know, the jobs numbers in the States were just horrific. But it's almost as if we'd already priced that in, that we didn't see the move happen right after that report was out, because that type of news, we've already pretty much understood that across the board, economic fundamentals are declining worldwide.
All right, we saw a really volatile euro-yen pair yesterday, and with the euro definitely getting pushed downward by the yen, and then we've seen the yen gain even more on the euro throughout this morning, especially after Treasury Secretary Paulson's comments. Is this euro-yen debacle going to continue?
It's hard to imagine an environment in which it doesn't, because if you want to imagine a world where we're back on solid economic footing, you have to have more than just oil prices decline, which has happened, which is, thank goodness for that. You've got to also have a stock market recovery, a housing price recovery, an American consumer spending recovery, a credit crisis thaw where we're unfreezing the credit markets, and all of those things that we're still experiencing all those things. And as long as we experience those conditions, we're going to continue to experience the great deleveraging, or what I call the great margin call of '08, where hedge funds have to put up more assets or more dollars in order to maintain the positions that they have that are on the books that are declining. Well, in order to maintain those positions, they've got to close out trades, and that's further depressing the market as a whole. Well, the big unwinding is really happening in these yen crosses that were so absolutely attractive back when the interest rate differential was greater and back when the worldwide economic picture was much rosier.
All right, Rob, thank you so much for being on the show today.
No problem. It's good to be here.
This has been your New York Forex Market Buzz with Rob Booker of Interbank FX. I'm Kathleen Reddington. Join us later this afternoon for PM Exchange right here on ForexTV.com.